Tony, should I be nervous about a 5% two-year yield?
Hey, Tom. Hey, Damian. No, you should be happy. You should be pinching yourself. You should be blissful. We haven't seen these yields in quite a long time. And it's one of the reasons why many people think that the U.S. economy is faring better. There's a story on Bloomberg today about it. Interest income in the United States is about $1.8 trillion today. That's up $300 billion from 2 years ago. It's $300 billion.
But the ambiguity is downplayed. I'm going to blame the media for this. Interest rates are
yes,
higher.
Of course.
OMG, price down, yield up.
Yeah.
But you know, and you've codified in all your books, including the great Steigum's, 2,000 pages, you've codified that there's an ambiguity here. Explain the ambiguity that price down, yield up can be good for our listeners.
Well, here's a statistic going back several decades. The 5-year, looking out 5 years in terms of what you're likely to get in terms of a total return, looking at the Bloomberg aggregate, which is a pretty much a compilation of the Bloomberg aggregate. Let me tell you what that is. Hey, by the way, on Lehman, I worked for Lehman Brothers in the 1980s in the World Trade Center, 104th floor with a view of uptown. Remarkable period that was. Yes. But so looking at the Bloomberg aggregate today, which is 40% U.S. Treasuries, 25% mortgages, 25% corporate bonds, the yield is 5.25%. Now, if you take that figure, that starting yield should be the return you get the next 5 years based on the 30-year history of it. The rolling return over a multi-year period should equate to what you see as a stated yield today. So 5.25%, is that good enough? For some investors, maybe not. That's why yields are rising, prices are falling, they're selling. They think yields will go higher. But I would suggest to investors that they be careful about the story now, and what I would suggest is thinking about 3 don'ts about what to do in terms of investing now. We're often asked about what to do. Here's what not to do. Right. For one, don't try to time the market. Awfully difficult to do. Secondly, sure, perhaps don't catch a falling knife, but do catch these yields while you can. These yields could slip away. And finally, don't fight the Fed. And Tom and Damon, you might think this means, well, the Federal Reserve is keeping policy tight, so it's a bad thing. But it's tough love. The more it stays tight, and it is getting tighter based on a definition of what is tight, a falling inflation rate, and it is falling, a 2.8% PCE versus a 5% yield. Right. They were almost equal last year. Fighting the Fed today means believing the central bank will be successful in its quest to bring inflation down. It has every means of an ability to do that.
Tom, did you see Tony wink at me when he said, "Don't be a short-termist to actually invest for the long term"? I mean, he winked at me. He knows
your act.
Well, I'm reading your note, Tony, and I gotta say, don't fixate on the Fed's 2% objective. Focus instead on the notion of quote-unquote price
one of my favorite ideas.
Stability. That reads like the South China Morning Post. Price stability. What is price stability?
Well, Damien, so I'm really old. Tom is much younger than me, but I recall a period before 2012, and I'm going to tell you what that means, when we didn't have a 2% price objective to go on. We had to go on something else. And what was that something else? A notion that prices are stable or they're not. So it was in 2012 that Ben Bernanke, the former Fed chair, implemented the idea of a price objective. Prior to that, called the 1960s, 70s, 80s, 1950s, what did an investor have to go on to drive prices higher or lower? They had to decide, are prices stable? Now, if we fixate as investors on the 2% target, you could miss a great deal of return in your investment portfolio. And many that have fixated on the 2% target in the past 6 months have lost a significant amount of investment return in their portfolios because we haven't gotten to 2%, but we might be achieving price stability, which Alan Greenspan and Paul Volcker defined as a level of price changes or degree of price changes that ceases to have an impact on business and household decision making. And that's where we're moving, and that's why the equity market is feeling better, because we're getting closer to an era of price stability, even if it's not 2%.
Tony, behind closed doors, some of the conversations I have with the people I know and that I respect, we talk about that 2% inflation target, and we try to determine what it would take for the Fed to consider removing that target. Now, I know it's far-fetched, but do you feel that the Fed in this environment can even remotely consider that if inflation stays persistently high?
It's highly improbable now. They can't walk back on the notion, especially with the inflation rate higher, because then market participants would lose their sense as to where the anchor is, because it's becoming ingrained in thinking. But again, as investors, we have to take a step back and decide, is the inflation that we're experiencing enough to get in the way of future cash flows for businesses, to pay you back at maturity, to pay the interest on your bonds, et cetera?